Greetings and welcome to TTG Update. Today, I wanted to follow up on Jim Kay's recent video discussing the current state of stock and bond markets and our plans for your account over the next few months. Portfolio Management 101, if there were such a thing, would tell you when it is the darkest and everyone is the most upset, buy and buy some more. This strategy resulted in a number of profitable stocks in your account. As Jim Kay indicated last week, these gains have resulted in the stock portion of your portfolio being somewhat inflated. Now let's take a look at what we've been doing to rebalance your portfolio recently and our plans for the immediate future. Now we are going to continue to take gains until we get your account back to a normalized allocation to stocks per your risk profile. This is called rebalancing. Let's take a look at some of the stocks that have already been sold in many of your accounts. You can see by this list that we've already sold quite a few items at very nice gains. Now, as we rebalance your portfolio and sell some of these stocks or sell portions of some of these stocks, there are two main considerations. One is the method that we use to get out of a stock or to sell a stock, and two are capital gains taxes. First, let's talk about the methods. The first method is just to simply sell the stock, which we have done, but the second is something called covered call writing. So what is a covered call? A covered call is a financial instrument that gives the holder the right to buy a stock at a certain price for a certain length of time. An option contract always covers 100 shares exactly. So if we own a stock, someone out there will pay us for the right to buy our stock at a certain price for a certain period of time. This is called premium. Now, this is a complex topic, so let's take a look at an example. We recently have been writing calls on JP Morgan. At the end of March, we decided we wanted to sell JP Morgan stock. And it's not so much that we don't like JP Morgan. We think they have good management and that they do a wonderful job. It's just that their price has become inflated, and we just think they're too pricey. So we wanted to exit. Now, at that time, the price was around $153 per share. Now, we could have simply sold at $153 and been done, but we noticed that someone would be willing to pay us $2.55 per share for the right to buy our shares at $155 until April 9th. And so we did so. We sold that covered call and collected the $2.55. Now, around April 9th, we were able to roll that contract forward, and we were able to collect another $2.34. And now that did not expire until April 16th. And finally, we rolled forward again to May 14th and collected another $1.67. So to summarize, instead of just selling at $153, this Friday, JP Morgan will likely be sold from your portfolio at $155. But you will get to keep all the premium, which currently adds up to $6.56. When you add the two together, the $155 plus the $6.56, we come out with a price that's 5.5% higher than we might have received when we decided to sell at the end of March. So, why use covered calls? Well, because 5% here and 5% there really adds up. Now, the next question would be, why not always use covered calls? And the reason is that the premium in a call varies greatly from stock to stock, and in many cases, the premium is not high enough to make it worth your while. Now let's switch gears a bit and talk about capital gains taxes. Selling a stock at a profit does indeed create a taxable gain. Now, we will tell you right now, it is our goal to create gains in your accounts. We want to make money. It's a good thing. And there's more good news. If that gain occurs in an IRA or 401k, there's no current tax on these gains. Furthermore, we're currently experiencing the lowest long-term capital gains rates of my 35-year career. So even if the gains occur in an after-tax account, you will be paying these taxes at a relatively low rate. So we do not see taxes as a negative, but rather as a positive. It means your account is doing very well. Now, for a political sidebar, there's much talk about a dramatic increase in the capital gains rates. The rates on capital gains have changed multiple times, and chances are they will change again. Our early read on the proposed changes is that most of our clients will remain somewhat unaffected, but we will not know until we know. One thing we do know for sure, failing to take advantage of gains when one has them often leads to something more expensive than taxes, and that is losing the gain altogether. As Jim noted last week, no one ever lost money by taking a gain. Well, we hope you found this information helpful. So long, stay safe, and have a great day.